Hello and welcome to KYC, a brand new show for NDTV Profit. In this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of, well, the companies that they are in fact tracking. Well, Know Your Company is a show in which we take you through all that action, in fact, give you some actionable insights as well into these companies. And today we have with us, and well, we're going to talk about a company from the real estate sector, and that is, well, Signature Global. Well, to take us through some of these aspects of the company, I also have with me Anushi, who's going to join us to give us more insight into the company. But let me start by taking a look at what the company does. Now, in terms of course, I've already mentioned the fact that it is a real estate company and well, it largely operates in the NCR region. And well, you know, it's transitioned into premium housing in just about 2024. It did venture into the mid-income housing market back in 2017. And at the moment, the market share of 13% in NCR and about 27% of its market share in Gurugram in terms of absorption of housing units from 80 lakhs to 5 crores. That's the ticket size around which Signature Global works with. And in terms of its project pipeline too, it has a pretty healthy one. Well, in terms of million square feet, it currently has an ongoing project pipeline of around 15.8 million. Recently launched includes about 9.5 million square feet, and we still have about forthcoming about another 25.4 million square feet. But Anushi, let's talk through, let's split this up in terms of categories too. How this 15.8 million square feet is divided into the various segments.
Right. So, Agam, you've mentioned at the beginning itself that the company majorly operates in the NCR region, and this is in the mid-income and the affordable housing side of the business that we are seeing. So, if we split it category-wise, mid-income on the Gurugram side, we're seeing about a 47.3% of a mix over here. In mid-income Sona side, we are seeing about a 19.7% of a mix, while in affordable side, we are looking at a 31% of mix, and in others constitute about 2.3% of mix. So, majorly focused in the mid-income and the affordable housing segments that it has started from 2014 onwards, and 2017 being the new venture that it was. 2024 focus was also on the premium housing side. So how that fares as a part of the mix is something that we should be watching out for.
Absolutely. And you know, let's move on and talk about the handful of metrics we rate companies with. This is mostly towards what the company has done historically. So we talk about their operational metrics in terms of, you know, in income statement. We also take a look at the balance sheet of the company going forward. Of course, we consider the shareholding pattern, what the street is making of it, along with the fact that how it has in fact done. And among the top of the key operating metrics, well, Anushi, why don't you take us through the particulars in pre-sales and collections specifically?
Well, it's been a very strong quarter for the, in fact, very strong first half for the business where in terms of pre-sales is concerned. Again, to note that real estate companies, they, the most important metrics to focus is on the kind of pre-sales numbers that comes out with the kind of launches that they've made in recent, and with the recent launches also on how they contribute to this pre-sales number. We are looking at a 217% of growth in the first half of 25, and collections about 60% of growth. This is in term 2,130 crore of a number that we are looking at. So strong performance as far as this pre-sales and collection growth is there.
Absolutely. And, you know, let's also talk about sales realizations at the moment. Well, what we have is that it's risen about 14% in FY24. Sales realization standing at around 13,500 rupees per square feet, approximately from around 11.8 thousand rupees per square feet. In fact, this has moved up considerably. And if you consider how things have moved from FY22, this number stood at a little less than 4,800 rupees per square feet. And gradually, as you can see on your screen there, it has moved up at a little less than 7,900 rupees per square feet in FY23. And well, in the first half, as you can see, at its highest at the moment so far. And well, in fact, the company is expecting the realizations per square feet to stabilize in this range in FY25, and we will pick this up with the management a little later on. But that said, you know, let's also talk about how all these factors have come together and tied up into its top line and the bottom line. At least as far as its revenues are concerned, we're looking at a very healthy 18% CAGR growth over the last 2 years, with the year ending FY24. And it's actually turned from a loss-making unit to a profit-making unit in FY24 as well. So that is also, again, a big positive. The only reason why we're assigning a neutral rating to this is because, well, I reckon that investors would want to see a larger chunk in terms of profitability, as well as, the very metrics as far as your operational levels are concerned. But again, certainly on a very, very steady footing as far as your top line is concerned. And, well, the fact that it's turned into profit is also a big positive. But Anushi, let's talk about the balance sheet then.
Right. So now if you look at the balance sheet figures, if we look where the net worth is currently about 636 crore of net worth that we are looking at. This is as of the September 24 figures that we are seeing. Other than that, what is important to concentrate is the kind of debt positioning that they have. Long-term debt stands at about 1,551 crore, while the short-term debt, if we look at the end of this period, that stood at about 731 crore. So including both of these figures, we are seeing a net debt of around 1,035 crore. Now, the business does intend to keep their net debt levels to operating cash flow, if you take both of these into account, below the 0.5x range. Cash balance also, we are looking at a healthy number. We are seeing about a 1,247 crore of a number. This is as of September 24 end that we are looking. So this is as far as where the balance sheet is concerned.
Okay, let's move on and talk about, well, the cash flows as well. In general, of course, cash flows have seen an improvement. The reason why we wouldn't want to give too much of an importance to the half-year numbers is because it's just halfway down the mark. But it has had positive cash flows from operations in FY24. That stands at around 92 odd crores. As on September, 2024, the cash flows stood at around 294 crores in the positive. This is cash flows from operations, mind you. And its net cash flows, well, consequently, were even higher at around 472 odd crores. But like I said, we're just midway through the year. So we're just going to wait and watch, which is why it's a neutral rating here. But in terms of shareholding, Anushi, it's been a pretty well-held company.
Right. In terms of where the shareholding is concerned, promoter holds about 69% of a stake in this. So a healthy shareholding that we are looking from the promoter side. Foreign institutions also constitute about 12.2% of the mix. Domestic institutions, we are seeing about 4.7% of what is there in parts of the 100% shareholding, and which leaves with the public around 13.4% of share with the public that we are seeing. So this is as far as where the shareholding is concerned. Promoters 69% of stake that we are looking at.
Absolutely. Let's move on and talk about, your street credentials. Now, naturally, given the kind of improvement that we've seen in the operating metrics, the last 6 months, well, the share performance has not been that amazing, but we must also bear in mind that the last 6 months in general have not been very kind to the markets as a whole. However, on a one-year basis, it has seen a whopping 46% growth. So not only has it outperformed the benchmarks, but we have seen it give you twice as much as returns of what the mid-cap and the small-cap indices have given. That's a 46% return in the last 12 months. And since listing in 2023, well, it has given you returns of 3 times, 181% growth since its listing. So it certainly has moved from strength to strength, and which is why we'd give it yet another thumbs up, because it's certainly been one in favor of the shareholders of the company. But, the final metric that we wanted to also talk about this time, it was the outlook. It does seem like it's a favorable outlook, Anushi.
Right, Agam. So if you look in terms of outlook, now we've spoken before about when we were discussing the portfolio mix of the company with the upcoming and the forthcoming launches, that they have about 50 million square feet of total available portfolio. So from that, if you look at ongoing projects, now these are slated to be completed by FY26. So this would lead to a revenue recognition of around 11,000 crore. This is between FY25 and FY26. that we are looking at. Estimated collection number also stands at a pretty good number. We are looking 6,500 crore from the ongoing projects. Now, for forthcoming projects, the timeline would be a bit higher. In the next 2 to 3 years, we should anticipate launches of some of the forthcoming projects that the company has stated in its presentation as well. And so this is on terms of what the ongoing and forthcoming mix could be like. As discussed, when we are talking about the net debt picture of the company aims to keep their net debt below the 0.5x level. This is from their projected operating cash surplus that they have. So this is the outlook that we are building in for Signature Global.
All right. So there you have it. One of the few companies on our radar who have absolutely no thumbs downs. Let's do a little bit of recap about how it has done in the various parameters that we are judging the company. So certainly a thumbs up in terms of its operational metrics. We've seen a thumbs up in terms of its sales realizations, income statement, neutral, but a pretty steady balance sheet as well. In terms of some of the other parameters, again, pretty steady cash flows. Of course, we will wait till the end of the financial year to give us an even better picture in terms of cash flows. Shareholding is well-held company, very strong performance in terms of its share price, and outlook also remains pretty stable. So where does that bring the total rating to? Well, 7 out of 8, certainly not bad. And of course, this is on the back of no thumbs down on the parameters that we have for Signature Global. So it does seem like it's on a very, very steady footing that the company is moving forward. And do remember that it has also moved into the profit in FY24. And it all will come down to how things could potentially pan out and whether or not we do see an expansion in the bottom line. But Anushi, stay with us. On that note, let's get in the conversation going on with Rajat Kathuria. He is the CEO of Signature Global. Rajat, good morning and thanks for taking the time out. Well, some very impressive operating metrics for you, Rajat. The question really is, if you could give us an idea on FY26 growth based on all the projects that you have on the anvil, and any challenges that could potentially pose for you that you guys are already factoring in as far as FY26 is concerned.
Yeah, sure. Thanks a lot for inviting us to your show, and a very happy new year to you and your viewers. So I am happy that you're giving a 7 out of 8 rating. We wish it was 8 on 8. But I would like to add on to a couple of points during the course of this conversation on a few things on how one should look at the financial statements. But starting with your point on the operational side for the coming year, see, we have about 35 million square foot of developable area, of which only a small portion, about 20%, is being launched over the last calendar year. Little higher than that, but there's almost 25 million square foot which is with the company and at advanced stages of approvals, which we intend to launch over the next 2.5 years. The potential, the GDV potential of this area is almost 50,000 crores. So we are fairly bullish on the supply creation in the coming years. And usually we've seen that in middle income housing, which is the core of our strategy, supply creation leads to demand creation. So we are going to put this supply into the market over the next 2 years, and trends have been very positive over the last quite a few years actually on this strategy.
Kathuria, this is Anushi joining in. First of all, wishing you a very happy 2025. What do you understand in terms of the market that you operated in, which is basically in the Gurugram region? What is the kind of industry trends that we are currently looking at? You've mentioned about demand supply. If you can get more on that side, how that would lead to the price realizations growth also for the next few quarters as we speak. And what is your overall outlook in terms of where the industry is heading for not just Gurugram, but even in the real estate sector as a whole?
So, Anushri, Happy New Year to you as well. So see, Gurugram is very uniquely positioned. It's probably, one of the few places in the country where a region which was technically a suburb about, 2 decades ago is taking like a city center sort of a positioning as of today, whether it be the demand for office spaces or availability of, grade A office spaces to high-end residential projects, to retail or any other social parameters you look at. So, that ways, if you see, Gurugram is like a very highlighted area in the entire NCR market, which is our core market as well. So the demand, honestly, is too tough to estimate. We think it's much larger than what is currently being supplied, in terms of housing units by various industry players. If you look at ourselves, we've sold about 2,000 units, in the first 6 months. So even if we sell something like 3,500 to 4,000 units, in the entire year, in terms of middle income housing, units, believe me, the demand is much higher and much more, and it's too tough to predict the real demand. And that's why you'll often hear in the Gurgaon market that projects are being sold almost at the time of launch or within a very short span of launch. This is just because there is very little supply, which got created over the last decade. And as supply is getting created now, it is being absorbed at a very swift pace.
Right. So now that you've given us a picture on how these realizations could, the demand supply picture is panning out, I want to understand your sense on what is the kind of pre-sales, the kind of collection growth that we can anticipate for not just the FY25 number, wherein you've seen already about 59% of your guidance achieving and 35% in where pre-sales and collections are, but for the next 1 to 2 years perspective as well, what is the kind of growth that we can see?
So, Anushri, we are fairly comfortable with our annual guidance of 10,000 crores. As we've already crossed 9 months, we feel very comfortable with that number getting achieved, which is for the financial year 25. Over the next 2 years, I would suggest that one can comfortably underwrite about a 20% odd sales growth to be achieved by the company.
Rajat, can you come in on your operating metrics? What is a good, ratio to judge your profitability? Because you're in the real estate sector. Because from what I understand is that you guys have recently entered into the premium housing segment as well in 2024. Does that mean that your operating metrics become even better in terms of your profitability?
Sure. So I'll just spend a minute over the broad strategy and then coming on to some of the operating numbers and how one should, look at some of, in a way, any real estate development company. So, see, our core of our strategy is to do middle income housing. Okay, that's what we've been doing. It was more towards value housing when we started, and we pivoted towards middle income housing over the last, in about 3 to 4 years ago. So the core of our strategy is to do homes which are for, households buying their first aspirational home. So, that's the need which we are addressing within our society. We've done 2 successful experiments on top of this core strategy. So in a way, we've added 2 more layers to, the strategy to make, our growth and more sustainable in nature. We went a little towards premium housing. So we launched 2 projects by the name of Titanium SPR and Deluxe GXP during the last calendar year, and we saw fairly good response on both of these projects. In addition to that, we've also launched 2 large townships which are on the peripheral areas of Gurgaon, which comprised of low-rise independent floors, which is effectively middle-income housing, or multi-purpose use commercial sort of plots. Both of these townships have also seen a fairly good response, especially the township by the name of Dakshin in southern Gurugram has seen very good traction from the customers. So, we have more tools available with us today. While the core strategies of middle income housing, we can stretch it up and take it up to premium housing depending on how the demand supply dynamics are playing out. Otherwise, we are very happy doing just middle income housing. Or, we are also very happy to have successfully tested this large format sort of developments. Each of these townships are more than 100 acres of development, and hence, there's very good, flawless, very nicely designed townships which one can do just at the outskirts of the city. So that's on the core strategy piece. But if you look at the operating matrix, for a real estate company, what's happening is that from a profit and loss account basis, we are recognizing revenue on completed contract method of accounting, which means that once you've completed a project and done the realizations from the customers, only then only then it gets reflected into the profit and loss account. What it also means is that what you're seeing in the profit and loss account is the picture which existed about 4 years ago. Construction cycle is at least of 4 years. So, as a thumb rule, or just as in a layman way, we are looking at a picture of the company which was there 4 years ago. So effectively, financial year 2021 projects which we would have launched are getting completed over a 4 year span, and that's what you're seeing in the current profit and loss account. Now, it gets a little tricky for companies which have seen J-shaped sort of numbers over the last 3 to 4 years, like ours. In financial year 21, we were doing pre-sales of about 1,600 odd crores. This year, we are targeting 10,000 crores. So it's a perfect example of, J-shaped growth in a company. Today, we do in about 1.5 months the sales which we did in the entire year in the financial year 21. So that's why P&L does not show the current situation of the company. Now the question is, how do you really understand companies like us? So we've given bunch of relevant information in our presentation, and we keep updating it. So effectively looking at the KPIs, for instance, we intend to do sales of 10,000 crores. We've talked about doing an average operational profit and EBITDA level profitability of 35%, on these sales being achieved, which means that on this 10,000 crores, the embedded or the implied EBITDA of the company is 3,500 crores. In a lot of these situations, we would have collected healthy collections from the customers, and these are like, done and dusted sales. But yes, the completion will take next 3 to 4 years. In some cases, at the best, 2.5 years. But in the P&L, account, it will show up in about 4 years from today. So, we are earning about 35 odd percent EBITDA on these numbers. You should also look at, collections and the operating surplus which the company is generating. So for the year, we intend to collect about 6,000 odd crores. Our operational surplus post taxes will be about 45%. So, we'll be in that range of 2,500 odd crores of operating surplus. That number stood at about 800 crores of surplus during the first 6 months. So that surplus is available to the company, either for further growth or for debt repayments. So one should look at cash flows, of these companies. And last but not the least, on this portfolio of 35 million square foot, which we were talking about, which has a GDV potential of 50,000 plus crores. This is mostly owned by the company. In real estate space, you will find a lot of companies entering into various kinds of agreements with the landowners, which we've also done. But by and large, this is owned land. The land is sitting in the company. So a good way to understand the balance sheet is that on the asset side, inventory, which is the largest, the most critical number, this 35 million square foot is sitting in the inventory of the company, which has this potential of 50,000 plus crores. Most of that land is owned by us. More than 90% of this GDV belongs to the company.
Right.
And there is nothing due to be paid on this land. On the contrary, nothing as in, by and large, nothing, there could be minor 10, 20, 50, 100 odd crores sort of numbers.
Yeah.
But on the liability side, the net debt number is only 1,000 odd crores.
Yeah.
So that's how, you really understand the balance sheet of the company.
Right, Rajat. That was quite a detailed information for the viewers out there who wants to understand the basics of the real estate industry in general. But with this, you've mentioned that you have about 50,000 crore of land GDV potential going forward. Want to get a sense on the kind of completions that we should be watching out for in the next half and even FY26 also in terms of where this could lead to the top line growth, how this would translate to the revenues and the top line growth for the company as well. And also, if you can just a quick follow up on that, if you can talk about the market share positioning of the company as well that you have. Where do you see the market share increasing to in the future?
So, Anushri, our so as far as the market share is concerned, uh, in the middle income segment, you could say we are roughly at about 18 to 20 odd percent of market share. We don't do absolutely luxury, or we've not been launching projects in absolute affordable space. So roughly in Gurgaon market, you could say we'll have about an 18 to 20% sort of share in the middle income housing, which is the largest sort of segment. Uh, we feel that the market will continue to grow because it's a healthy situation that there are a few players and few large players who are now creating sustained supply in the market, which means that customers have few options available when they go out for making a significant purchase of a housing product. So the market is bound to grow in Gurgaon. And with someone like Signature, the advantage is that we have this land inventory, such a massive dry powder available with us, which will help us to sustain supply. There are quite a few players who do not have such sort of a land inventory position in the Gurgaon. So hence their supplies may get disrupted over the coming years, whereas will continue to kind of come up with regular supply, and hence our market shares should improve in the quarters to come.
All right. Right. Okay, all right, Rajat, that's a lot of clarity, a lot of insight into your business that you've given us. On that note, thank you for joining us and taking us through all of that. Wishing you as well a very, very happy new year and well, the best wishes going forward.
Thank you very much.
Well, there you have. That's the management of Signature Global telling us about how things could potentially pan out. But that is all the time that we have for in this edition of KYC. But lots more lined up on NDTV Profit. Stay tuned in, and we'll be just right back.